Good morning, viewers. Sorry for that. This is your tutor CPA Charles Cafe, and today I've got a request from someone that they wanted me to help them with how they handle the issue of shares. Now I'm going to be talking about the issue of shares within the companies. First of all, what I want you to understand is that when you're talking about company accounts, we have different types of different types of companies. We can talk about them in terms of the companies which are limited by shares, companies which are unlimited, and we can talk about the other aspect of being a company being public and being private company, whereby a public company, for it is allowed to issue shares to the public, and the public can come and they buy the shares and become the shareholders within, which is not the case with private companies. Now we are going to be talking about shares, how these companies come up to issue the shares to the public. What are some of the reasons that forces or make them to issue shares? One of them, they want to raise money that is going to finance their operations. The other one, you can talk about when they have other financial needs that may arise as a result of their operations. If, let's say, they wanted to boost and put in new investment ventures within the business, they can go ahead and issue shares to the public so that they can be able to raise more capital. That's what we can talk about for now. But not forgetting, when we are talking about share, a share is a unit of capital. It is a unit of capital because we get that money from the shareholder. That's why it is called shares. We sell shares to the public, and when the public buys, we get the capital that we need to boost our business. It's different from debentures because debentures, for it is the unit of loan, where you get the loan from, let's say, a finance institution, and you'll be able to finance the operations of the business through getting a loan, which is mainly done by the private companies which don't issue shares to the public, or which are not allowed to issue shares to the public. There are so many aspects as in terms of the companies, the company information. And here what we are trying to look at, I'm not going to go deep into the theoretical aspect of getting the advantages and disadvantages of private and public companies, but I want you to get some idea about how this organization is, how the company is registered. When the company is registered and it is within the Company Act, we expect that that company, if it is a public, it's going to be giving out shares. And now, at the time of registration, we expect that the registrar of companies is going to authorize that company, he or she has registered, with a maximum amount of share. A maximum amount of shares that that company is allowed to issue to the public. Why are they limiting these companies by giving them a maximum amount of share that they can get to the public, or they can issue to the public? One, you may find that such companies, if you give them maximum number of shares, they may be having a lot of money which they will acquire from the people. But here they try to limit and they put a maximum depending on where the person is going to be investing and depending on which activities you have negotiated when you are pursuing that idea of registering your company, because you know what you're going to be doing in, and you know the maximum you may need as in terms of the capital that you may need. That's why you come into an agreement and you set the maximum amount of shares that you can be able to issue to the public. What happens is that when they give you the maximum amount of shares, if at all you want to give more than what you were given, it means you have to go back to the register of companies and try again to negotiate by bringing what factors that are making you to add an extra shares to that was given or to that was allocated to you at the time of registration. That brings us to the point where we have the authorized share capital. And we are saying the authorized share capital is the maximum amount a company is allowed to raise by issuing shares to the public. And here we are talking about the money or the monetary value, which means we are not talking about the number of shares themselves, but we are talking about the monetary value that arise from the number of shares that were allocated. So it means you must be having a certain value when they are giving you the maximum shares that you are supposed to issue to the public. They may also, through the discussions you may go through with the register of companies, they may also give you the unit cost or the unit share, that the value of each share they may estimate for you, or they may give you the unit that you are supposed to be selling to the public. If it is that, then we call that share, that share is called the par value of. The par value share is where the share is where the price of the share or the value of the share is attached at the time of registration. When you are registering the company, what you go through is by negotiating what will be the maximum that you will be offering to the maximum shares you'll be offering the public, and the value of each share that you are going, as in the price. They give you the price that you are supposed to sell to the public, because when you're issuing shares to the public, it's the same way like someone borrowing money from the bank, because you are giving these shares to the public, and the public, you are going to be paying them dividends as they become your shareholders. So when it is that, what you pay back is what we call the dividend that you will get, that the shareholders are going to be getting from the money they have invested into the business. So if that value is attached at the time of registration, we call it the par value of share. And there is a scenario whereby that there is no value attached. If there is no value attached, then we call those shares that they are shares of no value. When there is no value attached at the time of registration, it means that you can either sell these shares at a price which is higher than the nominal value, or the would be price per share of the organization. And if a company sells more than the nominal value of the share, then it means you are selling those shares at a premium. So we call that a share premium. And the share premium we are saying that shares are issued at a price higher than the nominal value, hence earning a profit on the issue. The nominal value is the face value of the share. If the share is let's say 10 million, you are supposed to issue it out to the public at a price of 10 million. But if you happen to issue that share at a price of, let's say, 12 million, then we say that you've sold those, or you've issued out those shares at a premium, which is the difference between what you've got minus what the face value of those shares were. Then alternatively, we may also be having a share discount, and this share discount, for it is a bit rare to see it because it's hard for someone to sell these shares at a price below the nominal value or the face value of the shares. But it may happen, some cases where it may happen, you find that the company is not too profitable, that it has the market, has captured a very good market, so it can discount the shares so that it can be able to get more shareholders on board. And what causes the other selling the nominal value at a premium? It may be that the company has a very good name and people are willing, and the demand for those shares is high, so it makes the price or the cost, the value of the share of the shares to increase. Those are the things I wanted you to get clarity on. One, we are saying the par value is the value that was attached at the time of registration, and if that value is not attached at the time of registration, then you will call those shares that they are shares of no value. Then if you sell these shares at a profit, or you sell more than the set or the given nominal value of the shares, then we say that you've made a profit out of the issue of the shares to the public. So it is called a share premium. And contrarily, the share dividend is when you sell the company shares at a cost which is less than the face value of the shares or the nominal value of the shares. So we can proceed. When we issue out the shares to the public, then those shares become issued share capital. What we get from that becomes the issued share capital. But the general rule is we can only issue out what we have. We can't issue out what we don't have. So if we are given the maximum shares that we are allocated to at the time of registration, and when we are issuing out shares to the public, we cannot exceed that. So it means issued share capital is the value of the shares actually issued to the shareholders from the authorized shares. It is part, or it is a portion of authorized share capital that is issued out to the public for the public to subscribe to them. That's what we issue out. You may issue out more than, sorry, you may issue out exactly what you were allocated for. If, let's say, you were given at the point of registration, you were given 10,000 shares, and when you are issuing out, you have the right to issue all the 10,000 out at once if at all you want, but you can't exceed the 10,000 limit that was given to you. And the only way you can do that is by going back and they change the authorized share capital to a different figure. Then, having seen the issued share capital, then let's look at the unissued share capital. Unissued share capital is the portion of that issued share, is a portion of that authorized share capital that is not given out to the public to subscribe to. We are saying that you may be given 10,000 shares at the time of registration. That is your authorized share capital. But when you're issuing to the public, you may decide to issue out 5,000 shares. Now it means the other 5,000 which is remaining unissued is what we call the unissued share capital. Then we have a note here. When we have seen what we've issued out, if let's say we issued out 5,000 out of the 10,000 shares we were allocated, then there is a scenario whereby those shares we are issuing out to the public, it doesn't mean that all of those shares are going to be applied for by the shareholders. You may find that at a certain point that these shareholders, they are not taking all the 5,000 we are issuing to them. And it may happen that they are taking only, let's say, 25,000 shares. And that 25,000 shares becomes our subscribed share capital. And that subscribed share capital comes out of the issued share capital. So we are saying the subscribed share capital is the part of the issued share capital that the shareholders have actually applied for. If we issued out 5,000, but the applications we've received, we have got the people who wanted these shares and they were 2,500. They were taking 2,500 of the shares we issued to the public. It means that 2,500 becomes our subscribed share capital. Then the other remaining becomes the unsubscribed share capital. The 2,500 which is remaining on the issued share capital 5,000 becomes our unsubscribed share capital. And we are saying these are part of the issued share capital that the shareholders have not yet subscribed for. Okay, we have a next one, and the next one is talking about the called up capital. Called up capital comes in a sense where the applications are made, and when the shareholders have submitted, or the public has submitted their offers in terms of the shares they want, then we try to call upon them, and we try to allot what they can take up using certain criteria. You may say that I'm giving the person, I'm on the basis, the person who comes first takes the shares. You may be on the pro rata basis, whereby you are using, if let's say someone submits in the application for shares, you compare that with the total shares you issue to them, and you see what you can be able to, which portion you can be able to give to them. But here we are looking at the called up capital is exactly that part of the subscribed shares. Remember, we subscribed for 2,500. But what happens is that the organization may decide that we are calling up, or we are making calls for the people who subscribe for our shares to come and make payments. They may tell you that you pay the whole shares you've applied for, or you are paying in installments, as we are going to be saying. If it is in installment, then it means they will be giving you different calls, whereby they will tell you that at this and this date, you're supposed to pay this amount for this and this shares. So the called up capital is that portion of the subscribed share capital that the shareholders have been called up to pay. It may be that someone is paying all of it, or they are paying half, depending on the policy that the organization has taken. Then there is that uncalled up capital. Uncalled up capital is part of the subscribed share capital that the shareholders are yet to be called to pay. They have not yet called them to pay for. And we have to look at a note that when you are looking at the called up and the uncalled up capitals, then we are looking at a scenario whereby they may call you and they tell you that on such and such a date, we want you to come and you start paying off. But by the time they call you, you may find that you don't have the money that they wanted you to pay. And you find that you had only, let's say, half of what they requested you to pay. You can pay some, and that amount you are paying in regard to the shares becomes the paid up shares. And the paid up shares is part of the called up shares. Of course, you only pay when you have been called. But if you have not yet been called, then you are not supposed to make a payment. But if they call you and you reach there, then you find that you are supposed to make payment. And at the moment you find that you have, let's say, half of the money they were telling you to pay, then what you are going to be paying, those shares, they will be the ones that are called paid up shares. They are portion or part of the called up capital that the shareholders have actually paid. Then the other one is when there is unpaid or the calls in arrears. Calls in arrears, it means that they called you to pay, but at the moment you find yourself that you couldn't be having that, you couldn't make the deposits they wanted. So you paid half, but they're still demanding. That is what we call the unpaid or the outstanding paid up capital, or calls in arrears. Those shares that have not been, that they called you to pay and you have not yet paid, they are the ones we call the calls in arrears. Then there is the last situation whereby they have called you to pay, but you totally don't have the money to pay. If, let's say, there are certain scenarios that have happened, or if they are taken long to call you so that you can be able to make payment, and by the time they start calling you, you find yourself that you are unable to pay this amount of money they want you to pay. So that becomes the forfeited shares. Those forfeited shares, they are part of the called up capital, where the shareholders have failed to pay the money that they called for them to deposit. And here we are looking at when they are paying the money, what are we issuing? Are we issuing whatever that was allocated to us at the time of registration? If we are doing it like that, then it means we are going to be looking at when the money is paid. If the money is paid at once, then we expect there is no problem and there will not be any cause. But if the money is paid in installments, we expect that you are going to be paying at a certain stage at which they will be giving you the cause. So having understood that, then we can proceed to the next one, and we try to look at what are some of the steps we go through when they are when the organization is calling for payment, but we are paying in installments. The reason why the organization may opt to receive money in installment is, one, you may find that if the organization allocates 10,000 shares and all the money is paid to the organization at once, they are going to be having a lot of money at their disposal. At the end of the day, they may not use all of the money, but they are going to be paying you dividends. So what they do, they keep asking in installments, that when they get stuck, they call for more money and they start pushing the operations. That's how it happens. So we want to look at how do we recognize these when we issue out shares, but they are payable in installments. We have the steps we follow so that we can be able to do everything within the organization. The first step is that what the organization does, they make sure that they issue out the shares. That's the first step. When they issue out the shares, what we expect from the public is to submit their applications. When they submit in their application, we expect that at the time of receiving the application, we expect to be receiving the application monies. It happens if, let's say, for these, you may find in certain companies when they are making bids, you find that the organization says that if you are bidding for, let's say, a construction of a certain block, we expect you to deposit in some minimum amount of, let's say, 5 million, that can be able to make us understand that you will be able to supply us whatever we shall be in need. If, let's say, you are supplying certain items, that's exactly what they do even with the organization when they are issuing out shares. What they do, by the time you submit in your application, we expect that you are going to submit your application money. Because we haven't had any transaction with you, then the best option of paying that money is supposed to be given to the bank. So within when you're seeing this whole idea of shares, we expect that we are not going to be using cash transactions. They may not happen. We are going to be using the bank. The money is going to be paid in the bank, so that at least we can be able to verify that this person has paid this and this amount, because it can be seen. No cash can be misplaced when you have paid the money through the bank. So all our transactions are going to be through the bank, not the cash. So we are saying that the first step is the organization to issue out the shares, and what the public will do, or the contending shareholders, what they will do, they will just submit in their application together with the application money. The second step is the organization, when the organization has received the applications together with the money you've deposited. Because what happens is that when someone is applying, they may issue out, let's say, 10,000 shares. But what happens is that you may find that one person wants to get all the whole of those shares that has been given to the public. You may find that you have allocated 10,000, but you find someone is applying for, let's say, 8,000, and another person is applying for the whole, let's say, 10,000. Other people are applying for 5,000, and all of that. What happens is that we will be receiving a lot of money, which is more than what we expect to be receiving from the shares we are issuing out. So what happens next is the organization to start vetting. They start sorting out those applications they have received, and what the decisions may be is, one, you may find that we've received more than what we expected. The organization may decide that let's try to reject some of these applications. But what does it mean to reject some application? It means rejecting application means refunding back the application money that was submitted, because when they applied, they submitted in their application money. So what they do, you make sure that when you're rejecting the application, you refund or return the money to those customers who have not been successful. That is the first step. The other thing, they may say that we are not giving back the money, but we are going to be using a pro rata basis. A pro rata basis, you get a portion or a fraction of what the shareholders has applied for out of the total number of shares that were issued to the public. That ratio you will be getting, it will be the one that you will apportion, that you will use to apportion the shares that person has applied for, to see what exactly you can be able to give that person. Because if you use the pro rata basis, it means that every application or every shareholder who has the contending shareholder who has applied, he or she must get, they may not get exactly what they applied for, but at least they will get something. Because when you get a proportion, everyone will be able to get, because we are getting these proportions out of the total shares we've issued to the public. Then it means every contending shareholder is supposed to receive something. Then the other scenario that may happen is, let's say to select one specific person and you give everything to that person. Those decisions, they depend on which procedures that the organization is using to make sure they do the screening of those shareholders, and they see the people who are capable of paying them the money as and when it is needed. So when that is done, when they have vetted the applications and they have allotted different shares to different shareholders as in the proportion of how they contributed, or using whichever scenario, then the next step is we start receiving the allotment money. Allotment means that we start receiving the money that was paid. Sorry, the money that is supposed to be paid on the issue, on the shares that has been allocated to certain individuals. But what happens in that scenario is that you may find that a person who had submitted, let's say, a lot of money at the time of submitting the application, you may find that we are supposed to refund that person the money. But what happens is that what they do, if they are using pro rata basis, they don't refund the money. What they only do is that the money that was received on application will be offsetted from the money that is supposed to be received at the time of allotment. That's what they do. And if you find that the money that was received at the time of the application, or when the person was making the application, is more than the money that is supposed to be given, or the money that is supposed to be paid at the time of allotment or receiving the allotment money, then the balance of that money, we shall convert it and we take it to the other calls. Because we said we allocate, then we ask them to give us the allotment money, then we wait until we do the other calls as and when we need the money. So if you find that the application money has exhausted the allotment money, then the balance is supposed to be taken to the calls account. So that when the person is called, he doesn't pay because he has already paid much money at the time of application. That's how we handle that if at all the shares are paid for in installment. Then the last one is that you may find that the person has submitted in the application money and we have allotted that person a certain value of shares. But what happens is that that person does not turn up when we make these calls. And when we start calling that you bring in your other amount and when we need it, you find that the person doesn't have the money at the moment. What we do, the person loses the money for application. The application money is lost to the shareholder. The shareholder doesn't demand anything because we called up and the person was unable to contribute to whatever he had applied for or whatever was allocated to that person. So when those shares are remaining, we call those shares, they are called forfeited shares, and those shares are transferred to the treasury. That's where they are kept. And when they are in the treasury, you may find that the organization may look at a scenario whereby they are going to sell them off again. But selling them off, they don't go through the same procedure went through at first. At this time around, they just issue out the way it is. If let's say 10,000, if let's say 1,000 shares were forfeited, then we expect that when they are issuing them out, when they are reissuing them out, they give them out all of them at once without going through the procedure we went through at first. And what happens if at all we get a profit? Because it may happen that this person was supposed to pay, let's say 2 million. And you find that when you reissue these shares, you find that you are going to get 3 million. That 1 million that will come as a profit will be taken to the profit and loss account that will be called a gain on the issue. It will be like the way we treat these other incomes that are got within the operations. So that's how we get that. The next video is going to be looking at a practical question, and we'll see how we can make sure we can be able to compute these shares, and we'll be able to get to know how to compute this. But the accounting entries or the double entry is just simple, because when you get the money, if let's say the money is paid on appointment, what we do, we debit bank, we credit the application. Remember, we have received the money on application. What we do, our cash is going to be increasing, but it is increasing as a result of receiving the application. So if it is an application money, then we are supposed to be crediting the application money and we debit our bank account. Then the other one, when you go to the allotment, when we are allotting, we said there are two scenarios. We expect that we are going to, we may find that we received more money than what we were supposed to receive in terms of excess application money. That one is adjusted within the application money by debiting the application and you credit the allotment. And what will be the difference of the application money and the allotment money will be again credited to the allotment account and debited to the bank, because it will be cash that we are going to be receiving. The other last one we didn't talk about is when we refund. Of course, we received the money on application, we received the excess, but we are refunding some of them. What we do is that we debit the application account, then we credit our bank, because we are losing money and we are paying the money back to where it came from. So the second list is where these calls, when the calls are made. When the call is made, we expect that we are going to, first, we are receiving the money from the calls. So it will be, we shall credit the calls account, then we debit our bank. The reason why we are debiting our bank is because we are increasing our assets. Then the last one is where there is that forfeited shares. If we have those forfeited shares, one of them, remember, those forfeited shares came as a result of the calls. We called up and people, they did not, some of them, they did not come to pay. So if they came as, if those forfeited shares came as a result of delay in the calls or not paying the calls, the calls money, then we expect that we are going to be debiting the forfeited share account and we credit the call account. Hope you've got that. Then when we reissue those forfeited shares, then our account is going to be debited by the forfeited share value, and we credit our forfeited account. But at the end of the day, we transfer these amounts, because the whole of these call, allotment, and application, they are just, they don't follow the going on concern, whereby for them they are just temporary accounts which are supposed to be closed off, and we transfer the money to the share capital account. Because you remember, in the statement of financial position, that's where we are supposed to put the share capital, and we are putting it in at the point where they are the equity, or that point where there is that owner's equity. That's where we put the share capital that we've been using in the production and all other things. And that's how we get to know that. Then the next video is going to be about the computation, and we'll see. I'm going to pick a question that is a bit simple, that can help you understand the double entry first. Then we go into where we are going to be having the share premium, the share discounts, at the same time when we have the forfeited shares. Thank you for watching, and God bless you.